commercial real estate debt, or CRE debt, in the United States is now $4.8 trillion, according to the Mortgage Bankers Association. Did you know that the largest category of CRE debt, with $2.2 trillion in mortgages outstanding at the end of 2024, was for multifamily or apartment mortgages, which accounts for 45% of the $4.8 trillion outstanding? Did you know that over half of the multifamily CRE debt is held or guaranteed by the United States government, mostly through Fannie Mae and Freddie Mac, which doubled their exposure over the last 10 years, and also held by state and local governments? The stuff is pervasive. So what does that mean? What it means is you and I, the taxpayers, are on the hook for over half of the multifamily CRE debt. Banks and thrifts are on the hook for 29% of the debt, life insurers for 12%, and private label, a CMBS, commercial mortgage-backed securities, are about 3%. The relatively limited exposure by U.S. banks to CRE mortgages indicates that CRE is not going to pose a systemic risk for the banking sector, right? But most losses will be absorbed by investors and the government, right? That means taxpayers, okay? Why is this important? Well, it's important based upon a story I saw today out of Wolf Street that I want to bring to your attention, because the commercial real estate sector of the United States is imploding, specifically office sector and multifamily apartment sector. Before I jump into the story, please don't forget to hit the subscribe button if you're not subscribed, so we can keep growing the channel. It's a free and easy way for you guys to support the growing community, so I appreciate you doing that for me. So Wolf Street says that the delinquency rate of office mortgages now in this country that have been securitized into these CMBS, I'll discuss that with you in a second, spiked to 11.7% in August. That's the worst ever. And that's even an entire point more than it was at its peak of the meltdown during the Great Financial Crisis. Then it was 10.7%. Now it's 11.7% on office mortgages. By comparison, back in December 2022, the office CMBS delinquency rate was only 1.6%. So it's exploded by over 10 percentage points higher now, okay? Greater than the Great Financial Crisis. And the multifamily delinquency rate is, these are loans backed by rental apartment property mortgages, jumped to 6.9%. That's the worst since December of 2015, almost 10 years ago, just before some of the big properties defaulted. Again, by comparison, 2 years ago, the multifamily CMBS delinquency rate was only at 1.8%. So what is, just briefly, a CMBS? That's a commercial mortgage-backed security, all right? And it's an investment product backed by pools of commercial real estate mortgages, office buildings, apartments, things of that nature. The loans are bundled together and sold as bonds to investors on the secondary market. They usually provide liquidity for real estate lenders and developers. Okay, and a lot of times these are at more favorable rates upon more favorable terms, so they can leverage in. But what happens when the value of the properties starts to drop, right, against which the loan is secured, or if the owners get into trouble because their cash flow drops, their vacancy rate spikes, and or interest rates stay elevated, well beyond what they were when they took out this loan. We're seeing that culminate now. And when a CMBS blows up, it happens because you have widespread defaults in the underlying commercial real estate loans, right? The borrowers of those loans, for any number of reasons, fail to make the payment. They go delinquent, okay? And what does that do? What that does is then you have losses starting to cascade down through all the investor pools, from the highest risk players to the lowest risk players. But as I just shared with you, the CMBS only represents a portion, right, of these. A lot of these are guaranteed by us, right, through the U.S. government, the taxpayers. So as we start to see, we talked about this on the channel before, the extend and pretend, where they don't really even show these loans as being in default as long as they're allowed to, let's say, cure delinquency by kicking the can down the road, extend the term. Also, if they get in some kind of a forbearance situation, if the loan's in forbearance or they've extended the term, what have you, they're not even really deemed delinquent. So we have massive commercial properties, multifamily office properties around this country now where these commercial mortgage-backed securities are going delinquent, okay? You are not seeing, and look at a lot of these loans were placed at 4%, high threes, and they're coming due, okay? The banks have already pushed the risk off their books, and they've pushed it off to investors, insurance companies, and a bunch of other suckers, right? They're holding this toxic debt as the underlying assets drop in value and the borrowers can't perform, they can't pay it. So what happens? You guys think for a second that interest rates, wherever they're at now, okay, are going to, even if the Fed embarks on an aggressive rate cutting cycle, are going to get anything down close to where these commercial real estate loan mortgages are sitting in the low fours? Again, love to get your thoughts and comments on this. I'm definitely not an expert. I'm not a real estate developer. I'm not a real estate agent, a commercial, but I am looking at this stuff. I do know I have a lot of commercial real estate clients that own brokerage firms and also are in the space, and they're telling me that it is a ghost town out there in big areas for commercial real estate. So as these things start to literally implode, what are we going to have? Well, ultimately, you're going to have another bailout, probably, right? A taxpayer expense, right, to somehow salvage this industry as these commercial loans and the multifamily loans blow up and the borrowers can no longer pay them, right? And they simply say, I'm done. They walk away. Then you've got more vacancies, more than you even have now. So I wanted to share that with you because I was, I guess, somewhat surprised to see that large of a portion of certainly the multifamily commercial backed loans are basically guaranteed by the U.S. government and therefore indirectly by the taxpayers. So where does this thing end, right? And another, as if we don't have enough things to heap on the economic turmoil pile right now. Now we have, commercial real estate loans in dire circumstances in this country right now. You're not hearing this much, I'm not, at least in the mainstream media, but it's something we all need to be paying very close attention to. Remember what happened in 2008? Look at even some of the big insurance companies, AIG and such, they got into massive trouble because those collateralized loan obligations and the pooled funds, again, once it started to spread like wildfire, the defaults, and it just built like a snowball going down the hill. Again, I don't know what's going to happen. I don't know how they're going to keep extending it and averting the disaster. But when you have the rates now this high, obviously it's not working. Okay, they can only extend and pretend so many loans. They can only forbear so many loans. Some are simply going to be defaulted, and they're going to start hitting the books. And we'll see how this rapidly let's say disintegrates. I don't want to keep you too long today. I hope the topic was informative because it does relate to all of us indirectly as taxpayers in this country, working very hard, and trying to meet our obligations. Then you have this stuff just lurking in the shadows, right? Thanks for watching. Thanks for giving me a like if you enjoy the content. Thanks for subscribing. And talk to y'all soon. Bye.